make people who don't
Mark.
look for a raised hand if you're looking for an extra seat. There's some extra seats. Look, keep your hand up if there's a seat next to you. There's some seats over here. The power of crowds. Anyone else? Seats over here to your right, sir, coming up the aisle. There's some there. There's some seats over here. Everyone take a seat. Keep your hand up if there's a seat next to you. It's good exercise holding the hand up. Okay, everyone seated that wants to be seated, because there are seats. Raise. Okay, I think we're good. Sorry to interrupt.
No, not at all.
Just being an activist.
This is great. Andy, there are seats here. All right. Well, before we start, I just want to add for the audience that Mark is one of our best and brightest advisors in UBS, but he's also a man of many talents. He's a talented actor, been in movies with Robert De Niro. He is a very generous philanthropist. So thank you for all you do, and thank you for making this event happen. We're very grateful. Bill and Ryan, great to be with each of you today. I'm very much looking forward to covering a range of topics before we open up the questions. So I'm just going to dive right in. First of all, there's a reason why three of us, three New Yorkers, are having this conversation here in...
A dog wants to learn from that.
Omaha, Nebraska.
It's a smart dog.
Okay. Where's the dog? Oh.
We love dogs, so that's okay.
Oh, there's really one?
Yeah.
Anyway, so here we are in Omaha, Nebraska, and there's a reason for it. I know that Warren Buffett has had major influence on each of your careers, maybe in different ways. So I want to start with you, Ryan. What is the significance of this weekend, and what have you learned from Berkshire and Buffett?
Sure. I mean, Warren has been an enormous influence on not just my career, but my life. And he's really the reason that I got into investing, and I would say it's probably actually the reason that I'm here working with Bill at Pershing today. I first started reading Buffett in college. A friend of mine gave me the Lawrence Cunningham book, Warren Buffett's essays, and I just couldn't put it down. I just felt like a whole new world had opened up to me. And by the time I'd finished reading that, I said, this is what I want to do with my life. I want to be an investor like this. It was just the most intellectually pure, honest, stimulating writing I'd ever read in my life. And so that got me wanting to be involved in the business. And then a few years later, when I was looking to get a job in investing, I told myself, there's a lot of places I could go, but I really want to go to a firm that truly believes and embodies these principles. And while I met with a lot of people, I think it really was when I connected with Bill, we first bonded over Buffett, and I thought I had known more about Buffett than just about anybody I'd come into contact with until when I met Bill, and the first conversation I had commented on one of Buffett's earlier activist investments, and he's like, actually, that was his second. His first was a different one, and then I realized, okay, this is a firm that I want to be at and that I really want to learn from.
Bill?
So my path to investing was, actually, I worked for my dad in a real estate services business, and it just seemed to me the people having more fun were the people we were servicing, the investors. And my dad's business was arranging financing for real estate developers and investors in real estate. So I decided I wanted to be an investor. Real estate investing is not that accessible when you're 22, because you need lawyers and capital and everything else. Stock market investing is incredibly accessible to anyone, because again, even then, it was relatively low-cost commissions and so on. But I didn't know anything about investing. My dad said, never been a great stock market investor, but you should talk to my friend Leonard Marks. And he introduced me to Leonard. He recommended Ben Graham's Intelligent Investor, and that took me down a path. I don't remember once you start with Ben Graham, at some point you end up with Warren Buffett. And there wasn't Lawrence Cunningham's book, but of course there were the letters. And so that was kind of my introduction. And I often say that the vast majority of what I know about investing, I learned from Warren. And sometimes you have to relearn things that you learned from Warren. So it's helpful in life to have kind of principles by which you operate. The same thing's true in business. And business and life have a lot of overlap. And I think he's been so he's been my informal mentor, since I was probably 23.
So I heard this, Ryan, from you before, that you thought you knew more than anybody else about Warren Buffett until you met Bill, and you mentioned it today as well. So maybe I'm thinking our audience might want to challenge you guys for Buffett trivia during the cocktail hours, if you're up for it. If you're up for it.
I'd never been to a shareholders meeting when I made that statement, just to be clear. So I was fishing in a different pond. As Buffett says, it's always about the pond you fish in. You just got to choose the right pond. So.
All right. Well, I put you up for the challenge. All right. So I want to come to Pershing Square. You just talked about investment principles. Can you maybe talk a little bit about your approach to value investing? What do your principles, your process look like, and how does that help you find companies that you would own for decades?
So I'll have Ryan answer, and I'll tell you whether he's right or wrong.
Okay. All right.
So I'll start with our principles, which, if some of you know our firm, we literally have carved in stone just to make sure that we never forget them, which I think is a really helpful way to visualize it. And you kind of can memorize these principles. But I would say fundamentally, I think first and foremost, what we're looking for are really great businesses. And what I mean by that is ultimately, we're looking for businesses where we can have a very high degree of confidence what the future will look like out 5, 10 years. And a lot of those things, I think, ultimately come down to, if you want to call it a Porter's 5 forces analysis, but really understanding the competitive dynamics, the secular growth opportunities, and feeling that you can assess with a very high degree of confidence about how a business can end up. It'd be a lot better than we think, but really, in particular, this concept of margin of safety, making sure it can't be a lot worse than what we think. So we put a high degree of what we call business certainty. So I think, Bill likes to say it's kind of the simple, predictable, free cash flow generative business, which I think is a great line. But that's really the thought process behind what we're looking for.
Did he pass?
I give him an A-. And the only thing I would add is the following. A business, I would add to his 5, 10 years, 20, 50. Again, in the discounted cash flow analysis of business, years 5 through 10, 0 through 10 are worth a lot more than years 10 through 20. But what you're really looking for, business is like a bond where the coupons vary and there's no date by which the principal comes due. So it actually, it really matters what happens over time. And I think, to make it, I think one of the big things I learned from Buffett is that you sort through the world for things that you can understand and know. What's fascinating about the stock market is securities move up and down every day on the basis of all kinds of information. And I think there are many businesses, it's just unknowable what they're worth. But they still trade, they move up and down. It's kind of an interesting sort of phenomenon. What we do is we kind of screen for the world for, by the way, I would give them an A, just teasing. But I would screen the world for things that we can predict and know. And that has something to do with what we know, but it has a lot more to do with the characteristics of a business that have a high degree of predictability. And what we think about when we're buying businesses are, these are bonds, really. We're looking for very, very high certainty, companies that we can theoretically sort of own forever. And that's the most difficult thing to do in investing, is not building a financial model, but predicting the durability, of a business, particularly in a world where there's constant technological innovation. When 2 students, who dropped out of, ABC, what used to be a great university, and rented a garage, and they come up with some disruptive technology, that's a very hard thing to envision. So you have to think about, think about moats. Michael Porter, who's another mentor of mine, at least, business school professor of mine, very sadly has severe Alzheimer's now. But the first book he wrote is probably one of the most cited pieces of any kind of research. And so you should, give it a read. Just thinking about the various balances of power, if you will, in the forces that affect a business.
I want to get into your psyche for a second, if I may. So many companies have principles, but Ryan mentioned it, and I actually saw it. You carved those principles in a stone tablet, and I think it's all over the office, right?
Yeah.
It's almost like your own 10, in this case, maybe 8 commandments. How did that come about?
Well, it came about by when we veered, right? So we had a great initial first, kind of dozen years of Pershing Square, and then we made the biggest investment mistake, certainly of my career. And when you're CEO, you take credit for the mistakes. 100% credit, you share credit for the successes. And the mistake made, had we stuck to our core principles, we'd never made the investment in the first place. And we'd always talked about these principles, but we hadn't sort of engraved them in stone. So I told a member of the team, come back with a piece of granite and a chisel, and we're going to put this up on the wall. And he came back with a deal toy, has a little weight in it, so it feels and looks a little bit like stone, but it served the same purpose. Actually, people underestimate the power of almost like checklists. Consider it a checklist. And the advice to the team was, if I ever veer, just hit me over the head with this thing, and it worked. And we've actually had the best, since the development of that little tablet, we've had the best 6 years in our history. And one of the beauties of the investment business is you can recover even from big mistakes. The power of compounding. Yes, never lose money, but when that happens, you can recover.
So when we look at your investments that you made based on those principles, you put a lot in restaurants. And maybe your best track record is from that sector. In a world where there's so much excitement about the next hot technology, AI, why restaurants?
Right?
So I would say, and to be clear, it's not that the restaurant sector in and of itself is something we think is amazing. It's a very competitive business. Consumer taste can be a little bit fickle. But I would say at a high level, the two types of restaurants that we've invested in, where we've had a lot of success, have either been, I'd say primarily most of the capital has been in franchised businesses. So they're not really the owner of the capital and running the businesses on a day-to-day basis, but it's really a royalty-based business where they clip a percentage off the top of every single customer and every transaction that comes in through the store. And what we think is amazing about that is it generates a very durable cash flow stream, and you can grow without capital. The owner who knows how to operate the business in his own or her own local market knows it way better than anybody else, and it's a very high return business. So I'd say that type of financial profile combined with the local knowledge of somebody who knows the real estate, who understands the operations, and who has their own skin in the game because it's their most important asset they're operating for you, that's been one category that's been incredibly successful for us. The other, though, is, and I think Buffett really talks about this, the best business is one that can grow without capital, so that's the first bucket. Second is a business that deploys a lot of capital but can deploy it at sustainably high returns. And those are the other businesses that we've invested in. And I think in that type of business, it needs to be one that really has a moat around its business. So it needs to own a category where it's hard to come in. And a lot of that is just, it has a brand that consumers think of. If I say coffee, most people would think Starbucks. So I think those are the types of businesses over time that we have been successful in. And also, those businesses tend to grow very, very quickly. So if you have a high-returning business with a great competitive advantage, a good management team, and you can grow that, then you're investing ever-increasing amounts of capital at very high returns. So we'd say those really fit our paradigm.
And also, it's a business where technological change generally is favorable. Mm-hmm. So AI, all the quick service restaurant companies today are testing AI and everything from the drive-through process, trying to predict, what deal to offer to the consumer, the customer coming back, what proposed menu, how do I optimize to maximize the potential from the customer. And so, technology is an amazing thing, but you want to own a business where the latest development of technology doesn't disrupt you. It actually enhances your ability to serve your customer.
I want to move to a little bit forward-looking outlook. When people hear about Pershing Square, the first thing that comes to mind is about activists, maybe single security investment. But you also had very successful investments around anti-consensus, sort of well-timed macro calls. I remembered around during COVID, whether it was head of the downturn there and then subsequent recovery and rising inflation. So what do you see right now around the economy? And any one of you can take it. And I'm not going to ask your positioning, but give us a bit of a sense of how does that impact your investments?
So maybe I'll give you kind of high level, and I'll ask Ryan so just where the strategy comes from is what I would describe as a deep appreciation for asymmetry. And in investing, you want asymmetry in your favor, which is why you don't want to short stocks. What I mean by that is you want investments where the risk of loss is much smaller than the potential for gain, or if you take, in fact, a risk of an entire loss, that the opportunity for profit is many multiples of the capital that you put in. And that you can find occasionally in equities, but in the kind of equities we generally traffic in, these sort of dominant, well-capitalized, investment-grade businesses, they can be great compounders, but you're not going to make 10x, 20x, 100x in a relatively short period of time. But in the sort of macro space, what's interesting is we live in a volatile world, and there are very few investors that kind of operate both in the equity space, where you're sitting on boards of directors, you're following lots of different businesses, you're learning about the economy by virtue of the kind of day-to-day business experience. Buffett should have a very good view on the economy by virtue of sitting on top of Berkshire. He gets the numbers every day. He's seeing what's going on in everything from truck stops to retail to shipping, railroads, et cetera. We do not have the same asset base as Warren, but we do get those insights, and you get a lot of insights by reading conference call transcripts. So we're sort of fundamentally equity investors, and from that we get insights into the economy. The other kind of part of the macro business is what sort of macro traders do, and they look at a lot of government data, which of course is always wrong and always corrected, so it's a kind of in and of itself sort of a complicated space. Interesting insights emerge. When you combine those two things, occasionally you have a view that's completely disparate or separate from what the rest of the world thinks. And if you find an investment like that, or if you come to that kind of a view, like you think the economy is much stronger than people think, or you think the economy is much weaker than people think, or you think rates should be much higher than where they really are, or inflation should be at a different level, occasionally you can find an instrument, some kind of option, derivative or otherwise, where the payoff characteristics reward you enormously for your view if you're right. And you can, because the payoff's so large, you can afford to be wrong a number of times and still have that strategy be really profitable. So that's kind of the philosophy, and that's led to a number of our most successful investments, certainly as measured by multiple of capital and even by kind of gross dollars made. But maybe Ryan can talk about sort of the economic backdrop and what we think.
Sure. So I think what's interesting, if you kind of go back to maybe the end of last year, beginning of this year, inflation, which has been really the key buzzword, if there's been any, in the last several years, it was starting to come down to a level which was pretty consistent with the level that the Federal Reserve targets, which is about 2%. At a string of inflation prints that suggested maybe we've overcome the inflation problem. At the same time, there were a handful of data points that were suggesting maybe the employment market was slowing down a little bit, and that there actually could have been a slowdown in the overall levels of growth or production. And so people, as you might have heard, started saying, the Federal Reserve is going to cut interest rates significantly this year. We've got a couple of data points the first few months of this year that suggested that view was not correct. And I think what's interesting is a lot of people, whether it's on CNBC or whether you look at pricing in the bond market or other things that you could observe, people think that generally the economy is incredibly strong. Inflation may even be reaccelerating. Perhaps economic growth is reaccelerating. And I think our view at the moment is we're actually a little bit more concerned that things could be slowing than is generally perceived. And that's not to say that we believe that there's going to be a recession or not. I think ultimately time will tell, and we're very open-minded about how things can unfold because the economy is very complicated and there are lots of feedback loops. But I think this is kind of the time in which it seems as if people are most concerned about inflation, most concerned about economic growth accelerating, what the Federal Reserve might have to do to combat that. Could we even have more rate hikes? And I think our view is that, and has been for the last several months, it seems like if you look at what companies are saying, that things are starting to slow. Not necessarily to a recessionary level, but people are starting to say that they really don't need to hire any more workers. They think the labor market is balanced as best as it's been since really before COVID. Companies are not talking really about inflation, interestingly, anymore. In fact, several of them within the last week have said that inflation, in their view, both from a labor standpoint as well as input costs, is back to pre-COVID levels. So we find it interesting when you get some of the fair number of companies that have reported in the S&P 500 that are sort of saying that these problems that are generally perceived in the news and that a lot of commentators are worried about, those aren't things they're worrying. And I think even just this morning, we got a little bit of a taste. We get monthly payrolls the first Friday of every month, and they were a lot lower than what people thought. Not at concerning levels, but they were low, and wage levels were low. So I think our view is the market seems to be concerned about inflation being resurgent, seems to be concerned that growth is way too strong, and we're of the view that things are slowing, could be soft landing. At the same time, we think things are a little bit more precarious where a slowdown could be something worse. So we're kind of trying to see, to Bill's point, that's a view. That's not a view we invest off of solely. In our sort of hedging program and our philosophy, it's all about, as Bill mentioned, it's about asymmetry, which means we need to have a view that's differentiated in the market. In order for us to put on a hedge, we need to be concerned that our differentiated view might have a problem for our equity investments. And then we need to find a security that can allow for a huge asymmetric payoff to make us a lot of money to protect against the risk of loss in our equities without risking a lot of money on that.
While we're on the topic of macro, I think you were, I'm going to say the big you, were very vocal when inflation was spiraling higher, that the Fed was behind the curve. Do you think now, Fed also, with the rate cuts being delayed, Fed might be behind the curve again, this time for the easing policy?
No, I think they're being prudent. I think in light of the strength of the economy, you wouldn't want to cut rates now, because the biggest risk, of course, is another spike of inflation that would be bad for the economy, bad for markets, bad for employment. And it hasn't really been costly for the economy, at least based on initial data. So I think the Fed's doing the right thing.
And then also, I know historically rates are not that high, but they're higher. And when rates are higher for longer, something breaks. Since the Silicon Valley Bank collapse, a lot of parallels are being drawn to 2008, especially around commercial real estate. Bill, you've been one of the few investors that navigated the housing crisis, which feels like a lifetime ago. How are you seeing this time around?
Yeah, so there is a crisis going on right now. If you own an office building in many of the cities around the country, and you have a mortgage, that at a 4.5% interest rate, and your building is getting emptied out as people don't need as much office space, and you're facing a refinancing at probably a 10% plus interest rate if that capital is available at all, and in fact, you're probably not nearly as much capital in the building, you're going to see a lot of office buildings being turned back. I mean, there's been a structural change in how people work. What's interesting about real estate is it's one of the few businesses where people say you can kind of ignore depreciation, right? The concept in real estate is the metric that people use is net operating income, which is basically a pre-depreciation kind of number. The reality is, if you walk around New York City, there are buildings that are actually worth less. The land would be worth more if the building wasn't there, because the building is outmoded. It's not ceilings are low. There's too much. You can't open the windows, there's not enough amenities, it's hard to redesign the building, and the building needs to be taken down. So I think there's a lot of fully depreciated office buildings that are going to be worth their accounting value. And I think the problem, I guess one of the good things is the big kind of money center banks really got out of, for the most part, lending to kind of traditional real estate developer investor types. The problem is that those loans went to kind of more regional banks. And regional banks do not have the wherewithal of the bigger banks. So I think you're going to see more regional bank failures, particularly ones that have kind of the big real estate exposure. What's interesting, though, about the office market, I used to say, people say, well, how's the real estate market doing? Well, it really depends, and it's a very market-centric business. Today, it's not just a market-centric business. It's if you want to just look at office, there's some office buildings in New York that are getting the higher rents, $300 a square foot, rents never before seen in New York, and then there are buildings you can't even give away the space. And so it's I think this is a moment where there's going to be a lot of white elephant type real estate that's going to end up in the hands of banks, will become land, or going to have to be repurposed to some other use. And I think that is a threat to the regional banking system. That's why my concern when Silicon Valley Bank went down is I don't think a world in which depositors take huge losses is going to be good. It would take down the rest of the regional banks, basically. You'd see this huge bank run globally. So I think we're going to have to manage through some bank failures.
But the systematic risk concerns?
I mean, I think it's manageable. I don't see that as the big black swan risk.
What about national debt in times of higher yields? Some prominent figures, Jamie Dimon, Larry Fink, has been ringing alarm bells. Are you as worried?
I think it's concerning. Look, when you look at leverage, you have to look at not just the liability side of the balance sheet, you have to look at the asset side of the balance sheet. And the asset side of the balance sheet, we still have a great country, and the government has some very valuable off-balance sheet assets, which include the ability to tax, right? So the U.S. government can, with the approval of Congress, unilaterally basically raise the percentage of an asset they own, including me, right? So if you think about personal income tax, right? So as the government makes adjustments, they're really just taking away assets from some people and giving assets to other people. So the problem, however, is as debt grows, there's only so much of that you can do before people exit, i.e. they find sort of other alternatives. And I do share some of the same concerns. What really Steve Mnuchin should have been doing, and Janet Yellen as well, is massively extending out maturities when rates were basically zero, and they were zero up until relatively recently. And instead, really both Treasury secretaries pretty much, and actually Yellen in particular, has kept the term of the federal borrowings at relatively short term. That is created, and the reason for that is that the short-term thinking of people in government. No one wants to be the Treasury Secretary that cost, when you extend maturities out 30, 50, 100 years, which we should have done, generally you pay a higher premium, which means that the budget is less balanced, it's less money for the president to spend in terms of, in the Congress to spend. So I'm very concerned about the fact that in the next, 3 or 4 years, something like 35% of the debt gets repriced in what is likely to be a meaningfully higher interest rate environment. And that is going to be a big overhang. And when you borrow money as a country, you're really, taking away capital from future generations. And, our fiduciary responsibility as the adults is to look after the next generation. And this is a very short-sighted thing for us to do as a country. And the amount of federal spending, it doesn't seem like there's any end in sight. And there's used to be the Republican Party was the party of, conservative finance. And now really both parties have not proven themselves to be good stewards of the budgeting process. So I think it's concerning. Good news is that the asset side of the balance sheet is, we've got a lot of amazing assets here. We're still the best house in a bad neighborhood as a country. And so the best and brightest still want to come here, but we got to fix things like immigration policy and so on.
Ryan, clearly geopolitics and domestic politics is going to stay front and center. Obviously, 2 wars in Europe, Middle East, and an election coming up. How does that play into your investment decisions, if it does?
So one of the things that we try to do in order to protect our portfolio from what I would call really exogenous risks that, if you're looking at a company evaluating it, you wouldn't think, I need to have a view on the geopolitical situation in the Mideast in order to evaluate this company. But they are there. I mean, some companies are clearly much more sensitive to that. I think about an oil company or companies that do trade with regions which could be affected by the war. But more broadly speaking, if really bad events were to happen in the Middle East, you had a true kind of World War III-like environment, that could have enormously negative implications for most businesses, and certainly could cause a pretty strong deterioration in their earnings. And so I think those are the types of risks that we focus on for what we kind of call this asymmetric hedging bucket. And so I think what we try to do is, something I think when Warren was hiring Todd Combs, when he kind of first selected his investment manager, he said he wanted somebody who was programmed to think about risks that had never happened before. So I think one thing we're always trying to think about is what could be risks that haven't happened before that could really be different this time. And then we try to think about what would be a way that we could protect our portfolio if that risk happened, while also not investing too much capital. So rather than saying, I want to go to cash because I'm worried about something, we say, no, we believe in the value of the businesses over a period of time, their ability to grow, but we know there could be a very potentially bad outcome here that's hard to handicap. So can we find something we put a very small amount of capital that would pay off 100 or 1,000 times in a really bad event? And so I think geopolitically, now you're thinking about things about oil prices, and then you could think about much worse outcomes if things were to spiral. Seems like we're, for the short period, and a little bit more of things have calmed down, but the longer term risks I think are still there over time.
So we talked about some of the risks in the economy, in the markets, race, geopolitics, election. But then on the other end of the spectrum, there is significant enthusiasm and excitement about artificial intelligence. Mm-hmm. How big of a game changer do you think it is? And also in the companies that you're looking at, are you seeing applications of AI that are particularly interesting right now?
Yeah, I think AI is going to be a huge game changer. I think, so in our view, and we spend a lot of time studying AI kind of at a high level, but also kind of on a more detailed basis for a lot of companies, I think that the applications for it ultimately will be enormous. I think it can be a very large benefit to productivity. One of the areas I think is going to be, and I think someday it'll roll out though, so it's not necessarily I think it'll change everything shortly, but one thing I think is going to be enormous is, for example, in the software industry. The ability to have an AI application that you can type in natural language, I want you to create a code that does this, or I want you to create I mean, Amazon on their call earlier this week was literally talking about how they have a new AI thing where you can just type in that you want it to create an app, and it will do it for you nearly instantaneously. If you think about the time, the development costs that saves, it's enormous. But I think the more important thing is, if I can do that in a minute or two, then how much more time do I have to be able to create other productive measures that I can focus my time? And that's a very simple example, but those are the examples I think that are already here, where you have a lot of very high-paid people. So I don't think it's going to be something that replaces all the workers, but I think it's going to allow people to be more productive, and that is going to ultimately be a big benefit to the economy. I think if you, on the other side of it, for example, what are we seeing? There are some very large tech companies where you're already starting to see, for example, Google, the benefits of AI are already improving their search. It is improving through some of the other social media companies, their ability to target people better. So I think you're making things more effective, whether it's people saving time or being able to do more productive things, or even when it comes to better being able to spend their money in a way that's beneficial for businesses. So I think it could take a while until you see the full benefits of it, but I think it's going to be very, very important to the economy.
And you have a very lean...
If I may, I just want to add one thing to what Ryan said, which I think is interesting. So a world today, if you want to, build an app, and you're not an engineer yourself, you got to hire engineers. And there's the distance between the creator and the software that enables the app. There's a separation between the two. But a world in which anyone can write software, or i.e. there's a machine that writes software for them, then there should be a huge explosion in creativity, because the most creative people in the world aren't necessarily the best software engineers. And so those are two very different kinds of skills. So a world in which everyone in the room, has an idea for a product, a service, or whatever, and they can, go to their genie and say, make this for me, I think is going to be a world with many more offerings, a lot more creativity, and I guess it could be used for good and evil, but I think ultimately a better world.
And you have a very lean investment team of 8 people. Do you ever see using AI to complement your process, your research?
We'd love to do it, and we're kind of actively looking for ways to do it. I think that may be something that is much further down the road. Yeah. There are things already in terms of machine learning that aren't, if you will, as sexy as AI, but I think can be very helpful in identifying trends in data, which can give you areas to focus on. I think one of the challenges with a lot of the AI right now, which is really kind of these large language models, is really what they are is predictive algorithms. So they take all the information they can, and then they just say on a probabilistically weighted basis, what is the next thing that comes after what was just typed? That's not really the way the human brain works in sort of making connections and thinking. So I think there still is a lot of work to be done in order to have something that can sort of take the view of kind of a thinking individual and be able to apply that to investing. What I would say is I actually think it can create a lot of opportunities, though, over time for us, because we really focus on the long term. And I think what's happened with a lot of this technology, whether it's going to be AI or even having been machine learning or even alternative data before that, if you think 15 years ago when people are paying to send helicopters over parking lots, that really created a much shorter term focus. And so that allowed for a lot of profit for people focused on the shorter term, but it also created more short-term dislocation in stock prices that would allow for more opportunities for the long-term investors. So I think that could be helpful for us over time.
What's interesting, so we own today, call it 9 or 10 companies. If we had to pick a portfolio of 100 things, or a manager who managed a portfolio by virtue of their mandate, they had to own, very highly diversified portfolio, it seems like a better application. Our approach is much more sort of handcrafted, and it's not just looking at a collection of data and saying buy, sell, hold, because we predict earnings are going to be up or down the next quarter. It's more like, okay, if we buy X% of this company and we have enough, we're a meaningful shareholder, understanding the personal dynamic of the boards of directors, who's running it, what's the probability that there's an opportunity to bring in perhaps a better person to run the company. It's a different kind of analysis. You can imagine a world where maybe AI can sort of figure that out over time, but I think it's much less relevant for us. One of the factors that affects the outcome of our investments is us. So we're not just reliant on kind of the empirical data, whereas a strategy that's very statistical, you would think, I'm sure every one of these quant strategies is investing enormous resources because it just seems like a useful tool because you could do things much more quickly. And to the extent it's a quantitative strategy, you would think that would be more helpful.
I asked this because there was a news this morning that JP Morgan launched Index GTP. They're going through all kinds of articles within stuff and creating a basket of stocks around those themes.
And it might work and it might not.
Yeah,
and what
exactly.
I would
We'll
say,
see.
the problem with it is, I don't know that you can have a lot of confidence it's going to work. And even if it works for 12 months, I wouldn't rely on that to presume it's going to work for the next 3 years.
Exactly. One more question around the innovation.
But I do want to give the audience a chance to ask questions.
Yes, I will. I have
Again, I know I'm not the moderator, but I'm an activist. Eventually we take over the panel.
I have one.
But she's excellent, though. I'm not being critical.
I have 2 questions, and at 25-minute mark, I'm trying.
We can always stay longer if people want to stay. Because we don't have dinner for a while.
I have nowhere else to go with you guys.
And Warren hangs out for like 6 hours, so we can.
I just want to pivot a little bit back to this spirit of Berkshire. Warren Buffett, Charlie Munger, they worked together, great team for decades. Maybe can you discuss a little bit your relationship? How do you work together?
That's a good one for you.
Sure. Look, I mean,
I'm learning as much from this as you guys are. So.
No, look, we started the conversation, talking about, how influential Warren was in our lives, and I would say Warren has been, one of the 2 most influential people in my life and career, and Bill's been the second.
It's okay to be second. It's okay to be second.
I mean, do you ever disagree? How does that shake out?
We disagree all the time. I think one of the things that's great, going back to when we talked about our carved-in-stone principles, is you lay out the most important things that really are non-negotiable. You can't be partners and not agree on a set of principles about how you see the world and how you invest. And everybody at our firm on the investment team truly buys into these principles. And almost everybody was there when we actually put them in stone. So I would say where we disagree are not about the big things, about does an investment truly meet our principles or not. I think we could have lots of disagreements about smaller things, about what are we seeing in terms of the economy. I think sometimes, when you're starting to look about an investment, you can have debates before you really get into do the work about, how do you think this might evolve? But I would say, I think the things that are going to ultimately determine our investment success or not, I think we have really great alignment, not just between the 2 of us, but to the team. But in terms of the way that we work, I think, we've been together now for over 15 years, and it's been I've had an amazing experience. I've learned an amazing amount from Bill. I learned an amazing amount from our team overall. And we have a really close working relationship. In terms of the day-to-day, Bill and I speak all the time throughout the day. On our investment team of 8 people, we really work in pairs of 2 very tightly. So people will kind of do their own work a little bit, but you're often working very, very closely with a partner. I'm always working with somebody on an investment, or I'm working with a couple different people on different investments at the same time, and we're always talking. We have lunch together, almost every day. We have a formal investment team meeting at least once a week, although we often have ad hoc meetings. So I would say it's really a very close-knit culture. It's also a very candid culture. And I think, again, Bill has really set the tone for how we operate. We have people who, I remember this when I was at the firm for, I don't think it was a year, and Bill and I went out and had lunch, and he said to me, I probably had my interview questions still after, only having been there 9 months. And I asked him, what was the best piece of advice anybody had ever given you? And he said, it was Richard Rainwater who told me, you don't have to be old to be right. And that was such an empowering thing for me as like a 24-year-old, because I felt like...
I almost think some people do. You don't need to be old to be right. Now that I'm getting older, I'm thinking about modifying that.
Great.
You can never be too old to be right.
Now we're talking.
There you go. Okay. I want to get one last question in. This is important for my friend Olivia's here, so I want to ask this. So I mentioned in the beginning, obviously you have a lot of things in common, admiration for Berkshire, but there's also something more common, another thing that's common. You're both girl dads. Actually, you have boys too. I have one daughter. Maybe it's and they're young, right? So I guess a 2-part question. One is, what's the best parenting advice for next generation or this generation from you guys? And then the other one is for anyone in the audience who has children, looking to get into investing, what advice would you give them? And my friend here, Olivia, who's here, she's 10 years old, 4th grade, already an overachiever. Violin, piano, squash, she writes music, so she's listening with full ears.
Actually, I told her, I met her also just today, and she gets to ask the first question.
Awesome.
Yeah.
What advice do you have? And then I'm going to open up to the audience.
What advice to be a good parent?
Parenting advice, and for those people who want to get into
advice.
investing.
So they're sort of a little in conflict, and what I mean to say is I'm a big believer that you don't really steer your kids to do stuff. They get inspired by something, and then you encourage them to do whatever it is that they're inspired by. Now, perhaps there are ways to kind of plant some seeds to get them interested in something if you think, but I sort of feel like, so first of all, I'm the wrong person to ask about getting kids interested in investing. My oldest daughter teaches history at St. Anne's School in New York City. My second oldest daughter just is graduating from a creative writing program at NYU. And my third oldest daughter, and again, they're all daughters, is also seems to be interested in kind of anything that math is uninvolved. So now there's Rika. She's 5. Maybe there's some hope that she gets interested in investing, but she seems to be interested in volcanoes and tectonic plates, science stuff. So again, so I think my piece of advice with respect to kids and careers is let them find the thing that's most interesting to them and encourage them and back them up, support them to pursue that.
Right. Do you have anything?
So one of the things I found so interesting about being a parent is I think about, my day job is all about performance. I mean, you wake up, you want to come in and come up with the next great investment idea. You just want to stay in the office, work hard all the time to try to really get it right. And so there's this huge emphasis on, did I get it right? Did I make the right decision? With parenting, it's so interesting. It's like my kids just think I'm great, even if I'm like terrible. There's this concept of performance is just showing up, being there, and being nice.
For now.
So this applies to kids who are ages, 8, 6, and 4. But for right now, I would say it's like just being there, which is not exactly what you could say for most things in life. Okay. And the only thing I would say in terms of getting kids interested in investing, much like Bill, we're not trying to push our kids towards any one thing, and it'd be amazing if they shared my passion, but we're not trying to push them on that. But what I would say is they wanted to do a lemonade stand this year after seeing another friend of theirs, and there's nothing like having a kid get their hands dirty and physically make some money for the first time and think, wow, hold on, wait, if I just made $20 after like 2 hours, and we didn't charge them for the cost of goods, so maybe that was our mistake. It was 100% margin business for them. But I mean, that really lit a fire under them. So I would say is go watch Bill's lemonade stand video if kids want to learn about business, because I think the lemonade stand really been very powerful in my family.
Right. All right, let's open it up to questions. We have a microphone.
So it's Olivia gets first question.
Olivia gets the first
Front row.
question.
Front
Can we
row.
get a microphone here?
Hold on. Someone's bringing the mic.
I should take a picture.
Other than Salita, why do you think there aren't that many great girl investors?
The answer to that, I think, is that people are inspired by others that look like them and share similar commonalities with them. And so when you have a field which has been historically dominated by men, there are fewer women think of that as a field that they could pursue themselves. So in this room, there are a lot more men than women. And I would say it's not for lack of capability or acumen. It really relates to choices that young women or girls make because if the most talented people in your community play a certain sport or pursue a certain career, you're more likely to say, oh, I could do that because that person looks like me. And so what we need to have more talented women to pursue the business that we love is we need to recruit young 10-year-olds to show up at meetings like this and to get inspired and say, hey, this is something I really want to do. This is like a memorable thing. And then you recruit a few friends, and each of them recruit a few friends, and soon you're running a pyramid scheme. Or you're actually getting people interested in investing. And it's really wonderful to have you here. But I think that's really the best answer. It's not like there are certain sports where our physical activities or construction, et cetera, where the fact that height or weight or strength matters, and where men might have an edge. Not all men, but men generally. But this is a field where none of those things really apply. It's about some amount of intelligence. Doesn't have to be too much, but hard work, sticking to principles, a desire to learn, persistence, and what Mr. Buffett calls temperament. And temperament is sort of your ability to insulate yourself from the volatility and the uncertainty of whether you're right or wrong as the stock market moves up and down. And I think, basically all of those qualities can be held as equally by women as men. So so tell me when you launch your first fund. I'd like to be your first investor. Okay, next. Who's ever closest to the mic? There you go.
Thank you so much, Bill. My name is Laurent, and thank you for awarding us the Pershing Square Challenge Scholarship back in 2019 and inspiring
This guy's already learning
students of
marketing.
value investing. So,
We have something called the Pershing Square Challenge. So if you're a Columbia Business School student, there's a course we started about 15 years ago where you spend the semester, you have to you pick a team of 2 or 3 classmates, and then you identify an investment idea, and then you do research on it, field research, the kind of research we would do, and then you put together a pitch, and then we sort through the pitches and pick the top 5, and then just this past couple days ago, you're in front of a couple hundred people, you present your ideas to a group of investment professionals in our industry, and the top, really typically the top 2 prizes get a $100,000 or a $50,000 prize. It's something that we started years ago, and actually winning this, the people who've won the prize have gone on quite successfully. So congratulations. It was 5 years ago that he won. I know this because that's when my daughter was born, and it was the first one I missed. I didn't get a chance to shake his hand. I did now, right before this. But go ahead with your question.
yeah, and thanks for inspiring young students, and I guess Olivia or even younger students of future investing. My question is actually about your vision for Pershing Square. Berkshire Hathaway is probably turning 60 years old next year. And what is your long-term vision for Pershing Square in the next, say, 30, 40, 50 years down the road? And also maybe also on the sort of fiduciary duty on the shareholder space in a little bit, because we see that the Berkshire meeting seems like a huge family gathering, and there are so many long-term shareholders and come here and really celebrate the long-term journey that they're had with Warren. And so I was curious about your vision for Pershing Square in the long term. Thank you.
Sure. So I'm a competitive person. So one of the things I told investors early on, they said, well, what's your business plan? I said, look, I want to have a better record than Buffett. That was 35 years ago. He was around 62 or 58, around my age, actually, interestingly. And I thought, okay, I'll have to compete with this guy for another 10 years, maybe 20. And now each year he keeps adding a year that I have to work in order to compete. And so look, we'd love to, it's actually a lot of fun making money for other people. It sucks to lose other people's money more than it does to lose your own, I would say. So one, you want to make money, but two, it's actually quite a beautiful thing to have a business, which is a great profitable business where you can work with people like Ryan and other extraordinarily talented people. And then at the end of the day, people give you money and they get more back, right? That's one of the things that makes this a really attractive industry. So my vision for Pershing Square is for it to be a perpetuity, so I do want it to exist into the hereafter. I do think what we do actually not just makes money for our investors, but I think, we've invested in, probably, I don't know, is it 35, 40 companies where we've taken a meaningful stake and played a meaningful role in the trajectory of the company. And I can give you lots of different examples. We don't have a perfect track record, but we have a very high batting average. And the vast majority of those businesses are much better and much more successful even after we're no longer a shareholder. And we can talk about railroads, we can talk about restaurants, we can talk about industrial gases. And that activity, I think, has had a very positive societal impact. I'm a big believer, despite the philanthropy, despite the giving pledge, big believer that capitalism will solve a lot more problems than philanthropy will. There are a lot of problems with philanthropy, which we can talk about. The corporate model and the incentives that you can create running a business and the kind of people you can recruit, that's how we're going to save the world. And so to the extent you can improve the performance of businesses, you can have big impact on people's livelihood, not just the people who work for the company, but obviously their customers, the other stakeholders, the communities, the government who collects taxes. So it's a business that has huge, done correctly, societal impact. And I think we've been part of in some ways led a shareholder activist movement. The time I got into the business in the early 90s, boards were a bit of a joke. They were kind of golf buddies of the CEO. People didn't think much about fiduciary duty. No one had ever thrown out a director off a board of directors. Whereas today, directors sit up a lot taller. They take it very seriously because they know that if they get thrown off by the shareholders, their career of being a director might end. And that has had a very powerful dynamic, not just on the companies that we've invested in, but when someone sees the worst run railroad in North America, a shareholder come in and get 97% of the vote from shareholders and recruit the best railroad executive, that leads to other railroads going through transformations, but it also leads to other CEOs and boards, taking governance and fiduciary duty seriously. So, I think what we're doing is inherently a good thing. And so I wanted to continue. Our model is not Blackstone. Our model is not to have, and Blackstone's an incredible business run by a good, very close friend I have enormous respect for, but it's really an asset management enterprise with, I don't know how many funds they have, and 4,000 employees, 2,400 investment professionals. And we have 8 on our way to being 9. We have 41 people in Pershing Square. I think we can do what we do with, a small handful of very, very talented people. The Navy SEALs versus the Army. I like the culture of that organization. I think we can sort of have a huge impact. And so we want to compound at a high rate over a very long period of time. And maybe, at 93, 94, 95, I hope I keep coming back to these meetings with Warren sitting there, giving us advice. So yes, I'd love to, my goal isn't really to beat Warren, but like to succeed for our investors, like to have fun doing it. And what's interesting about the nature of our strategy, and you see this, it allows for sustainability for the employees, right? If Buffett were doing, short-term trading, he'd be long gone, right? I think the strategy itself, what keeps Warren Buffett alive, he understands the power of compounding better than anyone else, and he just wants that next year. Because that, one of the things I did, Pershing, I like to say success is not a straight line up. Our story is kind of like this, and then we had this moment like this. And at this moment, I was 50 years old, and we had, our little public company had, now 3.9 billion of capital, and we had some hedge fund open-ended money that we thought would likely leave. And I said, well, where was Warren Buffett when he was 50? And the answer was Berkshire, when Buffett was 50, had 400 million of book equity, and we had 3.9 billion of book equity. So I said, at a really challenging time, so I said, okay, if all we do is compound this money at a high rate, we'll be fine. And that was kind of inspirational. But if you think about it, Buffett at 50 had created, had a business that might have been worth $600 million, maybe book and a half. And here we are. And most of that was accomplished, and all of that was accomplished in the last 43 years. So I still feel like we're really, really early on. Love to keep doing this and having an impact. The one thing that was mentioned at the very beginning is that we're launching this public entity in the United States. I've never liked the fact that hedge funds are just sort of for rich people. I sort of prefer to make money for the great masses than I do. Nothing wrong with rich people. I like, I have a lot of rich people are my friends. Nothing wrong with them. But there is a little more satisfaction, I would argue. You can have a more transformational impact on someone who's of more modest means. And a lot of people of modest means don't have access to necessarily the best. One of the problems we have in society right now is we have a group of people, I don't know, whether it's half of society that can make money while they're sleeping, and the other half of society that only make money when they're working, right? They get paid hourly, and if they get sick or they can't go into work or whatever, they're not making the $20 an hour or maybe the $25 an hour, where, we have a group of asset owners in society where they have a house that's appreciating in value, and that's not as certain as that was, or they have securities, or investments that are appreciating in value. And I think that's led to, obviously, wealth inequality, and that's led to a lot of resentment and envy. And what's going on university campuses today is sort of, relates to that whole worldview of, okay, so the successful people with assets are oppressing the people without assets, and we need to find a way to solve that problem and make ownership of capitalism something that everyone in society participates in. So when the stock market goes up, it's not just a small group of people cheering, but the whole country is excited for that. We need to fix that.
Hi, thank you so much for speaking today. So you talked about how Pershing aims to invest in high quality businesses, so they're capital light, high ROIC, strong brand, etc. But how do you balance the valuation component of these businesses when you're looking to invest in them, especially today when a lot of these great businesses, they seem to have very high multiples relative to their future growth prospects? Thank you so much.
Sure. So actually, what's interesting is Buffett says the best businesses in the world are businesses that earn very high returns on capital, and you can keep reinvesting a lot of capital into them. We sort of disagree a bit in that we think the best businesses in the world are ones that don't require any capital or minimal capital and literally can distribute out all their earnings and still compound at high rates and earn high returns. So I'd focus less on multiples, right, and more on, remember, you own the value of anything is the present value of the future cash you can take out over its times. A cheap stock can be at 35 times earnings, an expensive stock can be at 10 times, right? What matters is what the growth trajectory is and what are the qualities of the earnings or cash flows generated by the business. If 100% of the cash flows need to be reinvested for the business to grow, or even just to kind of stay where it is, that's a very different story, and you pay a different multiple for that than a business that literally is a royalty. If you look at our portfolio, we own businesses, and I guess I won't name them because of the legal advice we got at the beginning. We love businesses that are royalties, royalty collecting companies, whether, and those are, and ones we don't own, think about Visa, right? I was asked, I spoke at a business school like in 1995, someone said, what's the greatest business in the world you can come up with? And I said, it's probably Visa or MasterCard, which is a royalty on people spending. The mistake I made was not buying Visa or MasterCard when it went public. So we make mistakes at Pershing Square. But so I'd focus a little, multiple gives you an indication of your initial yield, right? If you're paying 30 times earnings, flip it over, you're buying at a 3% yield. The question is that coming to you in cash, or is it being reinvested at what kind of rate of return, and how can that grow over time? So it's a useful rubric to say, okay, what's the PE? But that doesn't tell you whether it's cheap or expensive. It's just one of the indicators of value.
More questions?
Bill, it's Stephen Clapham from Behind the Balance Sheet in London. Thank you for doing this and for giving us the opportunity to pick your brains. I've been an investor in UMG for many years, Vivendi, before it was floated. And I wrote when it was floated that UMG mathematically was worth more than Spotify. I was wondering if you could, without naming any stocks, give us a view of how investors are looking at the music industry today, where they're making mistakes, and how that might change going forward. Thank you.
Maybe I'll briefly comment, I'll turn it over to Ryan. So if you think about Spotify, it's in the business of distributing someone else's IP, right? It's a distribution channel, and there are multiple Spotifys. There's Apple Music, there's YouTube, there are other ways to get, it's a bit like the cable channel. It's not the content. If you have unique content, I'd rather own the unique content than the distributor of the content. Because I think one is more of a commodity business. Now, there are things the Spotifys of the world can do to differentiate themselves from others. And they're taking various steps to do that, creating premium, content for their customers. They've tried that with podcasts, et cetera. But, which would you rather own, right? Would you rather own the Beatles, or would you rather own someone who distributes their records? Ryan?
Sure. No, I think one of the great things about the record label industry in general is that it's really a royalty on the growth of music consumption. Companies like Spotify and other competitors in the space have created a much easier transmission mechanism. You don't have to go buy a CD anymore in order to listen to one song on it. Now you have all the world's, really, I think there's about 90% of all the music that's ever been created you can get on your iPhone. and listen to it for a very low cost. And so what that means is it opens up the aperture of music listening to a lot more people. And if you're a royalty business, you're getting a clip of every single song that gets listened to. And most importantly, that form of entertainment is probably the cheapest form of high-value entertainment of just about anything you can think of, because it really costs maybe 8 cents an hour in order to listen to it for the average user. That could be something people would pay a lot more money for over time. And these royalty businesses don't invest any capital to get all that future growth of all the music consumption around the world, and what we think is going to be increasingly valuable consumption that people will pay a lot more for. So it's really that business that you feel like you could own for a very long period of time, which is likely to grow at a very high rate. So those are some of the best businesses that we can identify.
And if you think about some of the structural changes that are bad for office, work from home, people working from home are listening to more music than people working in the office. You know what I'm saying?
Your points are very well made, but the stock market doesn't seem to recognize them. And that was really my question, because mathematically...
By the way, it's okay if your horizon is not short term. Actually, a business trading at a discount to intrinsic value can be worth ultimately more than one that always trades at its fair price, right? If you have a business that generates a ton of cash, it always trades at a discount to what it's really worth, versus a business that trades at fair value, that all same economic characteristics. You'd rather own the one trading at a discount because they've got another opportunity to use their cash to, in effect, retire their shares, right? That's an asset of a company trading at a discount that generates more cash than it needs, is the ability to buy out your partners at a discount to what the business is worth. And a lot of value can be created that way, and it's kind of another leg to the stool. So here's a thought. It says we've got 2 minutes and 46 seconds. I have nothing else to do. I'm willing to hang out. It's not rude if anyone wants to leave, but we can go 2 minutes 30 more. If we go offline,
extra 10 minutes if you guys want to stay, and now we can do more.
We'll stay as long, pretty much. If UBS runs out of time. Okay, that's fine. All right. Yes, another question.
Yeah, one more. So a quick question about AI and especially music. I've noticed there's 2 different AI generating music programs. I don't know anything about music. And I see Suno and Udio just came out, and people are making music, text to music, and putting it on SoundCloud and making money. So, and we talked about AI being a big disruptor, and just in China, I believe last week, video just came out, so it's going to be a competitor for Sora. And it seems like it's generating video pretty well. You could create your own trailers and whatnot. How do you see that affecting your businesses, especially in music and entertainment in general? How do you see that kind of affecting your investments?
Sure. So we're actually very excited about AI's impact on the record labels, really for 2 reasons. One, there have been some announcements recently where companies are talking about how anything that has kind of the star artist's intellectual property attached to it, so you can't go name your artist's song on these apps without that artist ultimately getting the royalties, which means it flows through the record label to the artist, so the royalty also goes to the record label. So as long as intellectual property is protected, then you can't really go create new music using your number 1 or number 2 hit star. No one can go create a Taylor Swift song off of Taylor Swift and her lyrics without paying appropriately for it. So in a way, that is still just music that's enhancing her brand, where she's going to get compensated for it. That's been a pretty recent development that we think is very material in the industry. And then secondly, I think what's really interesting, and this would go more broadly even than music, you could argue this in search, you could argue this in a lot of areas, but the easier it is to create things, the lower the barriers are to entry. So more people are going to be able to do it who would not have been able to do it before. And so what that means then is, in my view, the incumbents, the record labels, some of the people who own large search properties, those are the people in the pole position to be able to monetize this development, because the key in the music industry is how do you break through if now there are going to be several 100,000 songs that get uploaded to Spotify every day? Well, you need to be able to have a record label behind you to really break you so that people know you can go listen to the new song that Taylor Swift puts out, or whoever's going to be the next Taylor Swift. So I think some of these things that lower the cost of distribution ultimately enhance the ability for somebody to break through. And the only people who can do that are the record labels, or in other businesses like search, or some of these large incumbents that already own the market. So I think a lot of those benefits will ultimately flow to some of the most successful businesses today.
And if you think an analogy you can make in music, it used to be that a DJ would just play records, and there was very little creativity to being a DJ. I mean, there was some, just which song comes after the next. Now you have DJs that are actually getting paid enormous amounts of money because they're actually creating music. And I think it's a bit like the software analogy I made before, is AI will make many of us into composers that heretofore was inaccessible for us. And you would think the proliferation and increased creativity is going to create better music. Better music will ultimately find its market. There'll be better demand for it. But again, to Ryan's point, you have to, a world in which there's this massive proliferation, you have to sort through it. And what the record labels have done very effectively is they take a 18-year-old artist with an amazing voice and a great story and a talented composer partner or whatever, and they make that person a global star. That's hard to do uploading a song to SoundCloud.
Yeah, I agree. And one of the things that I've seen a lot is folks are training their AIs on anything, right? So Sora can't go to YouTube and train everything on YouTube. So actually having a ledger and doing all the clearing of the rights before and be able to show what they're training their AI on. But yeah, I appreciate it. Thank you.
Sure.
So there are a number of questions. We want to take them. For the broadcasting, for the live stream, we need to close it, but don't go anywhere. Once we close it, we can keep on going.
Right.
The questions.
Perfect. So yeah, for everyone listening in the United States and around the world, we want to thank you for listening and watching today. I hope you enjoyed the questions and answers from Ryan and Bill as much as I did. And again, you can also replay this. It's going to come back on the same link on Monday, so you can watch it again if you missed anything. And for everyone here in the audience, we're going to continue on, and we're going to also have a cocktail hour after we answer questions here, so Bill and Ryan can continue answering all your questions. Again, thank you all for listening on the live stream.